Welcome, everyone. We are so excited to have you with us today for Know Your Numbers, your guide to nonprofit financial statements. We are thrilled to have Todd here with us from Nonprofits First. He's going to teach you all about nonprofit financial statements. If you have any questions throughout this session, definitely go ahead and drop them in the chat. We'll be happy to answer them either throughout the session or at the end. As a few quick housekeeping items, we get this a lot. Yes, this webinar is being recorded, and yes, we will send the slides to you. So if you're frantically taking notes, don't panic. After this session, we'll send out an email with all of those good tidbits for you, so you can always reference back. Again, we're here for you today. We want to help you, so make sure to ask your questions and get some answers from Todd. So at any time, feel free to drop your questions in the chat. We'll be sure to address them. I also did want to call out that Achieve has a lot of free resources available to you on our website that can help you with your fundraising goals or maybe auditing your website. You can check all of that out at achievecauses.com/resources. We have podcasts, blogs, free downloads, all kinds of goodies for you. So feel free to check that out and take advantage of the free resources for you. So without further ado, I'll go ahead and kick you over to Todd and he'll take it away. Oh, you're still muted, Todd. Sorry.
Sorry, my fault. Thank you very much, Erica. And thank you, Erica and Sarah, for all the work that you do and to Achieve for supporting all of the nonprofits in the community. For those who don't know, they do wonderful work in the area of website development and many other internet topics. So please feel free to reach out to them, but they are also wonderful about supporting the nonprofit community as a whole, including things like this free webinar today. So go ahead and jump right in. As I mentioned in the chat, feel free to ask questions at any time. I've asked Sarah and Erica to let me know if the questions are directly relevant to what I'm talking about at the time. They may save some for the end, or if they know that that topic's coming up later in the conversation. All right, and our objectives today is to increase your knowledge and understanding of aspects of nonprofit financial reporting. So we'll talk about a little bit about board roles. I think some people here are board members. We'll talk a little bit about staff roles. We'll talk a lot about reading and interpreting financial statements and what to look for on those financial statements. Some red flags, and then we'll do some Q&A at the end. So first off, I'm Todd LaRue. I have been at Nonprofits First for 4 years. Prior to that, I was involved with Nonprofits First for a number of years in various other ways before becoming on staff. I have a graduate certificate in nonprofit management from FAU. I also have a master's in psychology from FAU. I've been in the field for about 12 years. I've been on nonprofit boards since I was 20 years old, and currently serve on, I think, 4 boards. Been a business owner. So when you hear people talking about, oh, nonprofits should be run like a business, I've been there, I've done that. I know the differences, and I know how much harder it is to run a nonprofit than it is to run your typical business. And I'm also a multidisciplinary researcher. I've published in journals across 4 different fields and continually doing work in the nonprofit area at the present. I want to mention just a little bit about Nonprofits First. So Nonprofits First was established in 2005. Our mission is to empower nonprofit excellence. And our vision is a community where nonprofit organizations achieve their highest level of impact. And we put the word desired in there because what every nonprofit wishes to do is different. So our goal is to empower you to accomplish what you want to accomplish. We have a number of different programs that I'm going to just skim over these quickly. Our accreditation program, where I do my primary work, is responsible for accrediting nonprofits in Florida and the broader nonprofit community throughout the US. We currently accredit about 85 nonprofit organizations, And then an outgrowth of that is our 501c Pro Toolkit for organizations that don't need accreditation, aren't ready for accreditation, or want something simpler. But that is full of the same questions that we would assess a accredited organization on, as well as many resources and template policies and procedures, finance manual, HR manual, things like that for smaller nonprofit organizations that don't have the resources to develop their own. We provide a wide range of educational and professional development. Many of the programs are free to our members. Some of them are free to the general nonprofit community. I am personally responsible for our leadership development programs, which include our Rising Leaders and our Advancing Leaders programs. Rising Leaders is a soft skills development program for those who are new to leading teams or managing groups. Advancing Leaders is the higher level, the hard skills that you need to have at the C level. So if you're at the C level, CFO, CEO, COO, Chief Program Officer, and you want to develop your skills, or you want to move into one of those positions, Advancing Leaders is for you. And that program kicks off at the end of this month, but our applications are open until Friday. So if you're interested, there's still a small window. We have a few more slots available. We also provide a range of management support services, and our signature awards program is held every year, and which we celebrate the rest of the nonprofits throughout the community. And in 2022, that program will be Tuesday, October 11th. It's a great event. Everybody wears fun and colorful hats, and we have a great time celebrating all of the many things that the nonprofits in our community do. So with that out of the way, let's talk about money. And I hope you have some. So I want to touch first on the major financial responsibilities of the board. And those are ensuring adequate financial resources and protecting assets and providing financial oversight. And while I say these are responsibilities of the board, they're also responsibilities of every member of the organization from top to bottom. So what does that look like? So it's always the board's responsibility to ensure that an organization has the funds it needs, make sure that it doesn't spend beyond its means, and that the board is participating in various ways to accomplish that. So they should contribute financially, typically, help develop and approve a fundraising plan. They may have more or less involvement in executing that plan, and then support and participate in the organization's solicitation and fundraising efforts. So their job in part is to connect the staff of the organization and the volunteers of the organization with their network to help increase the knowledge, the reach, and of course, the fundraising of the organization. So the other key roles is the protection of assets and providing financial oversight. So oversight looks like reviewing and approving budgets, a clear understanding of the organization's financial health, ensuring an annual audit is completed if relevant, and making sure that the 990 occurs, which has to happen for every nonprofit organization, although the exact version of the 990 may differ. And their job is to review and approve that as well. And then risk management, ensure that proper financial controls are in place and ensure that the organization is not subject to any unnecessary risk. All right, if there are not any questions about some of those roles, we'll jump right into what are financial statements. And I'm not seeing or hearing any questions, so we'll go ahead and move on. So your financial statements are your formal written records of the organization's financial activities at a specific point in time. They tell a story about the financial health of the organization, again, at that specific point. And that point is illustrated both in terms of the organization's current financial position and in terms of the activities leading up to that point in time. So we'll talk about what those key financial statements are in terms of both of those. So what is required in the way of financial statements? The minimum requirement, every board should be getting these, every organization should be producing these. The statement of financial position, sometimes known as your balance sheet. There's some other terms that are usually used, but those are the most common ones. And the statement of activities, also called the income statement or the profit and loss statement. So the statement of financial position is your opportunity to evaluate assets, what the organization owns, against liabilities, what they owe, to find the net assets. And we'll dig into that a little bit deeper as we go. The statement of activities is all of the activities of the organization in a certain cycle of time. Typically, it's from the start of the previous fiscal year up to the present. And you take a look at the revenues of the organization versus the expenses of the organization, and that gives you the change in net assets, or if it were strictly a private business, it would be considered profit or loss. In nonprofits, we normally consider that change of net assets, but they may change up or down, so profit or loss. There's some other financial statements that you may also see from time to time. One of those is the financial statement of jumbling my words here, statement of functional expenses. So statement of functional expenses, you'll typically see in an audited financial statement. Some organizations also produce this internally as well, but that reports by function. So the individual programs of the organization, sometimes they're all lumped together as program activities. Sometimes there's individual breakdowns by program. Administration, and sometimes known under some other terms, and fundraising. And administration and fundraising sometimes get lumped together in something that's called overhead. So if you've heard that term overhead, sometimes that's what they're referring to. Another way to look at functional expenses is by the natural expense category. So things like salaries and rent. And those are more commonly seen in your profit and loss statement. And depending on the statements that are generated, they may be broken down into greater detail or less detail. They should be telling you where the organization is spending most of its resources. And typically you want to see that most of the resources are going to program expenses. Another type of supplemental financial statement is the statement of cash flows. And this is a retrospective look at the cash activity of the organization. So it's looking at the cash received by the organization, the source, and where it went to. But it's all looking in the past. Where did that money go? So we'll talk a little bit more about that as we go through, but I'm not going to spend a lot of time on statement of cash flows because, as I said, it's retrospective. Most organizations don't find that particularly helpful. Some other recommended supplemental financial statements, a cash projection. So as opposed to the statement of cash flows, the cash projection looks at the incoming cash in the future and the outgoing expenses in the future, and should help you find times when cash may be tight, or those times when the organization may have a lot of cash. And an organization may have a perfectly well-balanced budget. That's the projection of what is expected to happen. But that cash flow projection tells you when it is expected to happen. So you may wind up with a balanced budget at the end of the year, but depending on when the money comes in and when the money goes out, there may be times when the total cash available is less than what you would desire at a particular time. And then you have to figure out ways to manage that. One of those ways could be delaying payments. You could have a bank loan for a short term, something like that, that would allow you to have cash available when needed. Other recommended financial statements is aging accounts receivable, or the AAR. So this shows the unpaid bills that the organization is responsible for, and it shows the amount of time that has gone by since those bills came in and how much time has elapsed since they arrived. And typically you want to see that the organization is paying their bills on time. So if you are a board member, for example, this may be something that the organization may not routinely provide to you, but it's something you may want to ask for to see that the bills are getting paid on time, especially if you see that there's points in the cash projection that show that there's low cash at particular points in time. The aging accounts receivable, payable is another example. This is those things that the organization has billed for but has not received payment for. And so typically this is not often goods and so much as it is services. But for example, many organizations operate off of reimbursable grants. So your aging accounts receivable will tell you that from when the end of the month closed out, how long does it typically take the organization to actually get that reimbursement request sent out to the granting agency, and how long it takes for that granting agency to pay that back. And typically that period could run anywhere from 1.5 to 3 months. So when you close out the month, you usually need 2 weeks, 3 weeks to complete that month closeout and calculate when what was done during the previous month, and then create the invoice and send it to the organization with whatever documentation is needed. And then you have a turnaround time waiting for the granting organization to have determined, yes, you did indeed do that work, and we're going to issue in a check. And then some period of time while that check is arriving, that can take a long time. And one of the impacts on the organization's cash flow can be that we have to do this work up front, and then we have to get reimbursed for it later. So it's important to understand that when you're understanding the role of cash in the organization. All right, I've been talking a lot. I'll take a breath and see if there's any questions before we move into some more details of some of those particular financial statements. All right, I am going to move on then. So the next item that we're going to talk about is a statement of financial position, or the balance sheet. So the balance sheet breaks down into 3 general areas. So the first is the assets. That's everything owned by the organization. Then liabilities, those things that the organization owes. And net assets, which is the difference between what the organization owes and the liabilities. And I see we've got a couple of questions coming in. So I'm going to answer a couple of these questions just quickly. Yes, we will send out the PowerPoint, and this session is being recorded. And when speaking of cash, do you also include in-kind in that? And the answer to that question is typically no. We're talking strictly about cash that is needed for things like paying salaries and paying to keep the lights on and stuff like that. In some organizations where they rely heavily on in-kind, such as, let's say, a food bank, where the operations of the organization means that you have to have that food in hand in order to distribute it out, you may want to have a separate document, separate from the cash flow, or it could be included on there, but with separate line items that help track that as well, so that you understand times of year when, for example, you get certain types of donations and when you need to get those out by for to make sure that they don't go bad, or you have spoilage, for example. All right, back to the statement of financial position, the balance sheet. So I want to talk a little bit in terms of what goes into that. And I'm going to relate that in terms of what we do in everyday life. So our assets as individuals might be things like our bank accounts, checking account, savings account. Maybe we have a some form of stock account that's not tied directly to our retirement. We may have some fixed assets. We may have real estate. We may have a car, some equipment, all those kinds of things. And then any other assets. So our other assets might be the furniture in our house, retirement accounts. If we held a yard sale and we sold everything that we own today, got rid of the car, all those things, how much money would we actually have in hand after all of that? That would be the sum of all of our assets. Then we take a look at what do we still owe on the car? What do we still owe on the house? Do we have other bills that have to get paid? That would be all of our liabilities. Some of them are short-term liabilities. Those are those bills we have sitting on our desk. Might be this year's car payments and mortgage payments would be considered a current liability, whereas future years might be seen as a long-term liability. So that everything other than what we owe this year would be a long-term liability for what we owe on the car, on the house, etc. And there are sometimes are special classes of liabilities. One of those special classes we see a lot in nonprofit financial statements is deferred revenue. And I'll talk about that as we go along. After we have sold off everything in our yard sale and sold the house and sold the car, and we've paid the outstanding bills and whatever, and we're ready to buy our sailboat and sail around the world, we need to know how much money we have in hand in order to be able to do that. And that would be our net assets. Now, of course, in a real nonprofit organization, we're not going to sell all that stuff off. And any net assets, if we were to do that, if the organization were to close down, would have to go to another similar nonprofit with a similar mission. But that tells us where we are. Are we positive? Do we have more assets than we have liabilities? So what is real property and personal property for a nonprofit? That's a great question. Real property is just what it sounds like. Many nonprofits own real estate. They may own their office. They may own facilities that they use for providing services in, depending on the type of services they provide, that may have multiple properties. And in addition, they may have properties that have been donated to them through fundraising campaigns or something like that over the course of time. In terms of personal property, the organization might have vehicles, computers, office furniture, other physical equipment that is necessary for doing their operations. So a food pantry may have a forklift. A medical organization may have some very expensive medical equipment. And all of that would fall under the equivalent of personal property for the nonprofit organization. All right, so when we talk about those assets, we also have to talk about them in terms of restricted and unrestricted assets. So unrestricted assets are any assets that do not have donor-imposed restrictions. They're available for general use of the organization. They're sometimes called general operating funds or general support. For example, if you hold a fundraising gala and you bring in let's say, keep it simple, $100,000, and you had to pay $35,000 in order to put on the gala, then all of that money that came in, the $65,000 that is left, would typically be considered funds that are received without restrictions. There's no restrictions on those. They can be used for any purpose of the organization. However, if you hold a special fundraising event for, say, a capital campaign, and we're going to have a capital campaign and we're going to raise funds to build our new building, when you hold that fund and you announce that it's for the capital campaign, that implies to the donors that the funds that they donate at that time or at that event are specifically restricted towards building that new building, and they can't be used for other purposes. You might also say, the funds received for this go towards our children's programs. And that means those funds could not be used, for example, for your adult programs if you have those. So those would be examples of when you could have an event that would lead to restrictions. Typically, there are different types of restrictions that apply. Some are time restricted. So you may say, okay, these donations or these grant funds must be used only in 2002 and 2003. We're going to give you $100,000, but 50,000 of it is available for you in 2002, and 50,000 of it is available for you in 2003. So that would be a time restricted donation. And you would record that, even if you hadn't received the funds, you would record that because you know those funds are coming in. You could have purpose restricted, which I already touched on, donor restrictions that are related to specific programs or activities that your organization does. And those may apply for general donations given by the public, but they also could apply for donations that are actually not donations, but are grants or other funding coming from foundations or government sources or other sources like that, where you are receiving the funds with the understanding that you are going to do particular work in order to earn those funds. And sometimes those funds are received in advance of doing those work. And other times that funding is received on a reimbursement basis, in which case the funds, once you receive them in hand, you've already done the work, so that is no longer restricted. The last type of restriction, common restriction, there are other types, is the endowment. And here, when I'm talking about an endowment, I'm talking particularly about a donor-imposed endowment. So when I say donor-imposed, that means that the wishes of a particular donor was that this money go towards an investment that will be for the life of the organization. And an endowment typically means that only the interest and investment returns can be used. And there may be some additional restrictions as well. But you can't dig into the principle of the endowment in order to operate the organization for most circumstances. There are other forms of endowments, so the donor may not impose that specific restriction. They may give limitations on when the principal can be used, but not ban use of it outright, for example. And sometimes there's what we call a quasi-endowment, where the board has designated funds that are going to be used as an endowment, but because the board designated them, the board can also undesignate them. So those restrictions function as a quasi-endowment. They're not a permanent restriction because the board can lift them, whereas the board could not vote to say, hey, we're not going to accept these donors restrictions on the endowment, except for if they chose to give that money back to the donor. It would be possible, however, to go back to the donor and ask that a particular restriction get lifted, and I have seen that happen on occasion. All right, so those are some of the things at the bottom of the sheet where you talk about the restricted and unrestricted assets. But there's some other questions you can also look at on the balance sheet. One of those questions is, does the organization have sufficient liquid resources in order to maintain operations? So this organization, I showed the balance sheet before, we'll get back to in a little bit later. But they have total current assets, which are pretty good, but it is important to look to see how liquid those assets are as well. You may want to see, is the organization building or maintaining a reserve? And of course, best practices in the field is to have 3 to 6 months of cash available as a reserve. We are in a area that's prone to hurricane-related disasters as well as others. So having those reserve funds on hand are very important. And yet it's very challenging sometimes for organizations to do that. We also ask sometimes, what is the current ratio? So the ratio of current assets to total current liabilities. And so I've put those at the bottom of the sheet. For this organization, we're talking a 10 to 1. They have a lot of current assets compared to their current liabilities. Higher ratios typically indicate more available resources to cover those liabilities. Now, remember, I talked about the liquid assets. So here we see there's a couple of red arrows. So we're seeing this organization has a very high accounts receivable and very low cash available. So their checking and savings accounts between them only have a little over $2,000 in them at this point in time. That would be a little scary to see. You see that, you should be a little concerned. How is this organization going to pay their bills? And we go down to the bottom and we look at that and they say, oh, they've got $63,000 in bills that they have $2,000 to pay. So then you start wondering about those accounts receivables. And that's where that aging accounts receivables report comes into play. How long have those receivables been sitting there? What does it take to collect them? How long is it going to be until, one or more of those gets paid? We also see that there's a line item for deferred revenue. So some of those accounts receivables is probably a grant the organization knows they will receive as long as they do the work. So they've recorded it as accounts receivable. They haven't actually received the money yet, but they've also recorded a deferred revenue against that, which says, until we've actually done the work, we're not going to get those funds. So it's important to know that's what that line item means. That is money or receivables that are to be received against work that the organization is to do. And so the accounts receivable will go down, but also the deferred revenue will go down by about the same amount each month. And then down at the very bottom of this, we see that there is a net income amount. So this organization is saying that over the last, whatever the period is, to get to June 30th. So whenever their last fiscal year end was until the current end of the period, June 30th, they've netted $6,757 and change. So that has increased their net assets, sometimes called total equity, down here at the bottom of the sheet. All right, so we're going to move on to the other form of critical financial statement, the one every organization should be producing, and that's the profit and loss statement. See that we've got a question in chat. So how often do I see accounts receivable between what is an active billing and what hasn't been earned? That is a great question. It's very variable across different organizations and the type of work that they do. Typically, the accounts receivable should show active billings. So if you see an AR report, and then they may be showing an additional something like, for example, we know we're going to get $100,000 this year, provided we also do the work that is necessary to do that grant. They may show that, but they're not actively billing portions of that grant until the month comes that they've actually done the work in, or the month after the month they've done the work in. So it can be challenging. The aging accounts receivable report should only show active billing and not items that haven't been earned yet. All right, so profit and loss statements. So this is in general what profit and loss statement should look like. And I've shrunk it down a little bit further in order to be able to show you the kind of categories that we're looking at. So typically what you're going to see is a category for revenues, a category for expenses, and then down at the bottom, the change in net assets or the profit and loss. So revenues might be things like service revenue, contributions, grants, fundraising, any program income if you charge for particular programs, perhaps you have a sliding fee scale or something like that. And then expenses, and you'll see the expenses are broken down into a number of different categories. Usually the biggest expense for most nonprofit organizations is going to be their staff. And then there will be a number of other categories. So again, in the pink box of expenses, you'll see that those are functional categories, but they are not necessarily the natural categories that the expenses come in. The natural categories are shown under the expense line over here on the right. So you see personnel, travel, rent, et cetera, going down. At the very bottom of the sheet, we see our change in net assets or our profit and loss. And we see a amount of $7,757 and change. Anyone have any questions at this point? All right, so let's talk about that change in net assets. So we saw that, that net income on the profit and loss statement. But if we go back and look at the balance sheet, we see that we are off by $1,000 on that line item. So those should always reconcile. Those should always be the same amount. The amount that you brought in over the course of the period on the profit and loss statement should be the same amount that's showing as your net income on your balance sheet, or should be the amount that your net assets have gone up and your total net assets from whatever the prior period was. What do you do about it? So the very first thing that you would do is ask why. And if you are a CEO or a CFO or someone within the organization, you're going to be doing the research to find out what's going on here. And the most common thing that we see at Nonprofits First, and I look at probably 300 to 400 sets of nonprofit financial statements a year on the average. So the most common thing that we see when we see that is that the organization has an audit every year, and the auditor has provided that organization with some adjustments that they need to make in order to bring their financial statements in line with what the auditor believes, after having done the full audit, is the actual statement of the organization's financial position. And somewhere along the line, one of those adjustments, or one or more of those adjustments, either were not made or were not made in a way that they feed back into both the balance sheet and the profit and loss statement appropriately. And so they've gotten out of alignment because of that, or because of the timing of that. But it doesn't mean that anything is wrong here. It just means that those weren't done in a timely fashion. Now, once they've been noticed, and if they continue to not be fixed, then perhaps something is wrong. And often what is wrong, and this is common across all nonprofits, the organization is understaffed, particularly in its management functions. So the last big piece that I want to talk about is getting back to the cash projection. So here we see the same organization. And in this organization, we are seeing that the organization did indeed project that they had low cash at this point in time. And they're projecting in the future, they're going to actually have negative cash, which means that they have expenses that are greater than their actual available cash is going to be for a few months. By the end of the year, they're going to get back to their balance. They had a budget, the budget pays off. They have a bunch of money coming in later in the year, but unfortunately that money is not available now. So that's important to know, and it's important to know how that's going to be addressed, because if you can't pay your staff, and so let's talk a little bit about some of these things. So we talked about that cash, the $2,000 in cash. Is that enough to meet obligations? The flip side of that is there excess cash? Does the organization have a lot of cash that is sitting there in a checking account or savings account? You know, in that circumstance, you may think about the fact that they're actually losing money. The amount that even a savings account is paying out now is often less than the current rate of inflation. So that money sitting there in cash is becoming worth less each day that goes by than even if it's collecting interest, than it would be being used in some other way. Does it need to be invested? Should it be used for operations? Is there other things that the organization could be doing with it? Again, when we're looking at a very large accounts receivable compared to the amount of cash on hands, we'd want to look at an aging accounts receivable to verify that that's actually turning over properly. And you certainly want to be paying close attention to any accounts receivables that are over 90 days old. What else might you want to pay attention to? Sometimes you'll see a balance sheet where there's no accounts payable. So liabilities is saying, hey, we don't owe anything. That's very, very rare that there isn't a bill that's come in that hasn't been paid yet. That has not reached the point of payment yet. It's very common for that to happen. So just like in your personal household, the bill comes in the mail, you put it on your desk, you're going to get to it later, you know it's due at the end of the month. Sooner or later, you write that check. But in a nonprofit organization, those bills are supposed to be recorded in the system as soon as you know that they are due. So sometimes when you see no accounts payable, you see an organization doing what I would call a desk drawer accounting system. So although they claim to be using accrual-based accounting, they are sliding those bills into the desk drawer, hiding them away until they are actually due or sometimes even overdue, in order to make it look like they are in a better financial circumstance than they are. So that would be a big red flag. If you see there's no accounts payable, you want to verify, are there actually no accounts payable, or is there some other reason why that's not showing up? Has bills not been recorded in the system that should have been? Is there something else going on here? Another red flag, as we mentioned, is accounts payables over 30 days old. So that would be the AAR report. If you see that starting to grow, or you see that doesn't change from month to month, you should be beginning to be worried about that. What should be included in current liabilities? What is included in current liabilities? So I mentioned already, if it was your personal liabilities, it might be your car payments for the rest of the year and your mortgage payments for the rest of the year. The same thing is true for a nonprofit organization. So typically in the current liabilities, you would see the sum of any mortgage payments or any rent that is due over the course of the current year that the organization is in. And in the remainder of that would be under a long-term liability. Other things, of course, are bills that are currently due, anything that's overdue, et cetera, would all fall under that category. Is those liabilities high or low compared to total revenue and the current cash? Those are things you can look at. And we already touched on that deferred revenue, so I won't talk about that anymore. And move on to the next slide. So we also want to do a comparison to budget. So we want to be thinking about how the organization is performing compared to the budget. So these are the things that we would look at in our financial statements. Typically, an organization should be providing a profit and loss statement that shows a comparison to budget. And they should do that either with every P&L or at least quarterly throughout the year. So the board members and the organization itself, the staff, et cetera, can look to see how are we doing? How are we doing compared to that budget? And some of the things that you look for are significantly under budget variances, significantly over budget variances. So if you're not getting the revenue in that you expect, or you have expenses that are higher than you expect, and particularly you want to look at those things that are big budget variance for what is a large expense item. So if you have a line item for stamps and it's 10 times what you expected it to be, but what you expected to be was only $50, and so now you've spent $500 on stamps, that is a huge variance, but it's a very, very small item, and it's probably not worth spending a lot of time researching. On the other hand, if you have salaries, which is likely to be one of your largest line items, and there's a big variance on salaries, it's important for the organization to know why. I say scan the report to look for inconsistencies. This is always very important to do. I was looking at the financial statements of one organization a couple of weeks ago, and they had a typical petty cash line item of $200. And right below that was a line item of over $12,000 that was also indicated as being petty cash. Now, I'm not sure what kind of organization would need $12,000 in petty cash, but that's a lot of money to be sitting around. And when I went back and asked the organization about it, they mentioned that it had shown up that way on their P&L for several months. So in this case, it was just a misrecorded item from a special event they had, but that can also be a red flag for other things like fraud. So for example, one of the common forms of fraud is to move items into a line item and sit and wait to see if that is going to be noticed. So you set up this petty cash line item, you put $12,000 in there, you watch and see if anybody on the board or anybody on staff notices that $12,000 for several months, and they don't notice it, then guess what? That cash now just goes from the organization into my pocket, and the line item goes off of the profit and loss statement. And who's going to go back and say, hey, what happened to that 12,000 petty cash line item? They didn't even notice it when it was there. They're certainly not going to notice it when it's gone. So again, in the particular instance, I noticed that was not fraud. There was a reasonable explanation for it, but it is a circumstance where fraud could be suspected. Another example would be on unbudgeted items. All right, so let's talk a little bit about performance review in further detail. So this is an example of what you might see. So here we see that the organization has their month's worth of expenses, August of the year. They have the two dates, so from October of the prior year to the current month, and they have their budgeted amount. So here we see that their year to date is, I'm sorry, this budgeted amount here is for the month. The budgeted year to date budget is over here. Their year to date on their insurance line item is well under what the year to date budgeted amount. So why is that? And those are the kinds of questions that you might ask if you see a variance like this. Now, this is a positive variance. They haven't spent anywhere near as much as they had budgeted for on insurance. So you might look at that and say, hey, things are great because but maybe that insurance bill hasn't gotten paid. You know, that's the kind of questions you need to ask. Another case might be that the insurance bill just comes due at the end of the year and they haven't actually even received the bill yet. Or they haven't received the major bill that they're going to pay in that yet. And they've split up the budget so that it looks like it comes due every month because it was convenient to divide the budget up into 12 equal portions. And so that's why the year-to-date budget comes out that way. But if you look at the cash projection, you should see that the month that line item is due in the cash projection is some future month, and it's due as a lump sum when that insurance bill comes in. So again, that's one of the ways that you can reconcile between the cash projection, which is telling you the timing of things, and the overall budget, which tells you the total amount of things. So let's talk about some other red flag items, and then I'll wrap up quickly with these, and we'll have some time for Q&A at the end. So if the financial statements are not being sent out in advance of board meetings, typically you want to have them with enough time to review them, which means anywhere from 3 to 4 days to a week in advance. Certainly you want to see, you know, that you have time. If your meeting's on a Monday, you want to have time to have the board having reviewed them over the weekend, those kinds of things. Remember, board members are typically volunteers, so they want to be able to do this on their time, not during their business day. So sending it out 2 days in advance of a meeting. If the meeting's in the middle of the week and you send them on Monday for a Wednesday meeting, the board members may not have enough time to look at them because they only have 2 evenings in there in order to get that done in. Are the change in net assets positive or negative? And again, this ties back to not just in any particular month, but an overall trend and projections for the full year and where we are against the budget. Is the overall net asset balance positive? So in other words, overall, does the organization have more assets than what they owe? And generally, this should be true, although there are cases where an organization could have long-term debt, a mortgage, for example, that may push them into negative asset, net asset territory, and yet are perfectly able to handle on a year-to-year basis all of the expenses that they have, including the share of the mortgage payments or whatever it is that is the long-term debt. As I mentioned, you want to check to the statements of activities and the statements of financial position reconcile to each other. Are there line items with the same dollar amount that are being carried over multiple years? We've seen this from time to time, again, in some of the many financial statements that we see here at Nonprofits First, where you see a particular line item show up 2 or 3 years in a row with the exact same dollar amount in there, in which case you have to wonder what's going on. If it's a cash account, is that bank account being updated with the current balance? Is it an expense account line item? Is that truly an expense that's exactly the same every year? Those kinds of things are the things you want to ask. You want to look at, does the organization's grant-funded programs require external fundraising to break even? In other words, if you go out and say, hey, we want to get a grant from Foundation so-and-so, and they're going to give us a grant for $100,000 to do this program, but our expenses for this program are $120,000. So we have to go out and raise an additional $20,000 plus whatever it costs to raise that $20,000 just to break even. Is that the right program to be doing? Now, I can't answer that question for your organization because that may depend on the nature of the organization and the funds that you can get. But you need to think about that. Are there recurring issues regarding shortage of cash? In other words, does the organization really have the cash reserves that they need in order to be able to do operations on an ongoing basis? If the organization operates on a reimbursement basis from grants, for example, is there always a shortage of cash at the end of the month waiting for that next grant check to come in? In which case, can we either build up cash or can we get the cash coming in quicker? Are there things you can do to work with the funder to streamline that process? Are there internal processes you can change to make sure you get that request invoice out to the funder in a more timely basis? Those kinds of things. Is depreciation being recorded on an ongoing basis? So for small organizations, typically depreciation is not being recorded on an ongoing basis. For a small organization, they typically total up the depreciation at the end of the year. But on the other hand, it's usually a small amount. For a larger organization, depreciation could be significant and could be an important part of whether or not you have positive or negative net assets. So knowing what is being recorded and when it's being recorded is important. Although depreciation is really an index at the top level of the organization of the amount of use that we're putting on our equipment and supplies. So you could think about depreciation, for example, of a vehicle as an index towards the remaining life of that vehicle. So on the positive side, you have the vehicle, that's an asset of the organization. Below that, you have the amount that that vehicle has been depreciated over the last however many years, typically 3 to 8 years, depending on the value of the vehicle or perhaps computer equipment or something like that. And that tells you as a board member or when you're taking a high level look at these nonprofit financial statements, what is the expected remaining life of this asset? So when that value of the asset reaches zero and the depreciation reaches all of the original value of the assets, it's probably about time to replace that asset. And it's time to buy new computers or a new vehicle or whatever the asset was. That is not true, of course, of real estate, but we record depreciation the same way. All right, so this is just for fun. Have you ever been here? Fred's giving the treasurer's report. He says we project a deficit of twice that in the previous period. We're not sure if we can even keep our doors open. And you got somebody saying, oh, thank you, Fred, for that nice report. Let's move on. Covering it up. You don't want to be there either in the general aspect of being worried about whether we can keep our doors open tomorrow, but also in the fact this is really a pointer at often the approach to the financial statements is, oh, I don't really fully understand these. These are kind of dry and boring. Let's brush over those and get into the fun stuff like what happened in our programs. Tell us a nice story. But those financial statements should be a nice story about how the organization is doing, and you should look at it as such. And hopefully this presentation has been helpful for you to think about the questions you can ask. So what can you do? You can read those statements with an inquisitive mind. You can ask questions. You can look at some of the red flags I mentioned. Particularly ask questions when some financial indicators might change, dips in cash flow, increases in liabilities, funding changes, and looking at that profit and loss statement by program on a regular basis. So to sum up, hopefully you're not in this circumstance anymore. You have a better understanding of financial statements and your organization still is in good shape. And with that, I will open the door to questions. And I know there was a couple that came in along the way. So.
All right, Todd. So Sean asked, how often do you see the AR split up between what is an active billing earned versus what hasn't been earned?
I think I touched on that one during the presentation, but typically active billing should be anything that you're currently billing for or should be billing for and haven't yet. But those bills should already be due when they're sent out, whether or not you've actually put them in the system or billed them out yet. So the aging accounts receivable should only show the active and not some anticipated revenue, even if you know that you're going to get to it in 6 months or 8 months. That shouldn't show in aging accounts receivable.
And you might have answered this one as well from Anna. Is depreciation considered a cash expense?
So depreciation is not considered a cash expense. There's no cash that's going out to pay for depreciation. Your assets overall are declining due to depreciation, but the current assets, that money that you have in hand, those things that you have to immediately pay liabilities, does not change. So no, it's not a cash asset.
All right, and we have one more from David. When carrying large amounts of cash, particularly in the case of restricted grants already received, would moving the cash to an investment account require approval from the grantee or just the board of directors?
Typically, it does not require approval from the grantee, and just something that require approval from the board of directors, or depending on the policies in place, maybe something that the CEO can implement directly, even without going to the board of directors. But that is a great question. Typically, the grantees are happy to know that you're shepherding their funds in a way that helps preserve them. So it may be useful for them to know that. And if the grantors look at the organization's financial statements, it may be also useful to have informed them ahead of time that this is what we're doing. We're putting these funds into an investment vehicle to help make sure that we don't have losses on them until we are ready to use them. We've been conservative in our investing, so we don't expect any losses from the market, say, and we expect them to grow in interest or stock growth or whatever. You do have an obligation as an organization to preserve the assets overall. So you want to make sure that you do what a prudent person would do in investing. Obviously, and in any investing you do has the risk of some loss, but you want to do it in a way that minimizes the loss and minimizes the risk for major loss. Any other questions?
I'm not seeing anything come through, but if anyone has any questions, you can certainly reach out to Todd. I'm sure he'd be happy to answer any questions you have. We'll be sending out the slides, which will have his email contact information on there, as well as you can always reach out to Achieve at any time as well. And thank you so much, Todd, and everyone for joining. This was super helpful today.
Thank you so much, everybody, for attending. I'm so glad to see so many people here. And as Sarah and Erica said, I'm happy to answer any questions. And my thanks to Achieve for making this possible and for making it possible without a cost to each of you who was able to be here today. Thank you.
Thank you. Have a great day, everyone.